Welcome back. You're watching The Firm. There's the Narendra Modi Gujarat model of governance, and now there's the Maruti Suzuki Gujarat model of manufacturing and governance. And in this one too, the minority is a confused lot. Last week, Maruti announced that it will expand manufacturing via a 100% Suzuki-owned subsidiary. The deal looks like this. Maruti will lease the approximately 1,000 acres of land that it has acquired in Gujarat to a 100% subsidiary of Suzuki Japan. The Suzuki Gujarat subsidiary will manufacture vehicles only for Maruti and as per Maruti's requirements. For this, it will be paid only cost of production plus adequate cash to cover incremental capital expenditure requirements. That means no return on capital employed for Suzuki Gujarat. Maruti will save capital costs, benefit from interest earnings, be able to invest in other functions such as marketing and distribution and R&D. In short, Suzuki puts cheap yen funds to work and Maruti reaps the benefits. Lovely then, a win-win deal for all. But minority investors are not so convinced. Several institutional investors and proxy advisory firms have raised questions regarding this manufacturing structure to try and understand their concerns and find out how Suzuki could benefit at the cost of Maruti's minority shareholders. I have with me today Amit Tandon of IIS and tax expert T.P. Oswal. Gentlemen, to both of you, a quick warm welcome. It looks on the face of it too good to be true, which is why so many people have raised eyebrows. Why would Suzuki want to put its own money to work when Maruti has the cash to do so? Why are you taking away manufacturing from Maruti? Why are you therefore altering Maruti's, sort of profitability stream and making it more of a distribution-led profitability stream? How are you taking value away from Maruti in this? That last question, I think, underlies all the suspicions that face this structure. Amit, what are some of the circumstances in which you think this structure stands to disadvantage Maruti's minority shareholders?
Look, our belief is that it adds to a layer of complexity and it reduces the transparency, and it's for this reason alone that you need to kind of question the motive behind it and say that, look, it's not necessarily good for the minority investors.
Let me play devil's advocate, since we don't have anybody from Maruti here, to say in short to that the world is a complex place. There's a lot of manufacturing contract work that goes on, outsourcing work that goes on. That can't be the only reason that you would object to something like this.
Let me just add to that. If you're looking at the added complexity, the reduced transparency, and then you add the fact that how they behaved in the past, and one of the examples we have is, as far as royalty is concerned, we've seen that repeatedly what Suzuki has done is that at every opportunity they've raised royalty in bits and pieces. And go back 5 years, they were paying about 500 crores as royalty. Today it's 2,450 crores. So the royalty has gone up significantly faster than either the top line or the bottom line of the company. So that doesn't give us any comfort as far as how do we expect Suzuki to behave as far as this venture is concerned.
Devil's advocate, your issues with royalty cannot spill over to this structure.
The other issue is that our sense is that, look, it's an unequal relationship. So you've got Suzuki, which is manufacturing setting up a manufacturing facility, and you've got Maruti on the other side, which is going to be buying the cars, and it's an unequal relationship. So I'm really not sure what this not-for-profit entity which they've created is there. At the end of the day, they start off with 250,000 cars. They end up with 1.5 million cars, not having financed any of it other than the initial investment, saying that the money is going to be flowing in from Maruti, and you say it's a not-for-profit entity. But let me pause here and say that, look, the relationship at best is not equal, but what this is doing is it's kind of hollowing out Maruti systematically and strengthening Suzuki's. We find the timing of this whole announcement also a little bit curious, to say the least, because I look at it, Tata's had taken about a year to set up a facility in Gujarat. These people are saying that, look, they're going to start manufacturing in 2017. So they had, this is about 3 years before they're going to be actually setting up.
Let me articulate what you're saying. You're saying they're trying to time it before the New Companies Act is fully effective, so thereby evading the need to have a majority of minority approval for all of this. But the truth is, Amit, that won't they, when they sign these contractual agreements of supplying units to Maruti, etc., assuming all of that is not already ready and it's not going to get passed in the next 2 months or so, we're hopeful that the Companies Act will come into force in the next few months. So it's a fairly good chance, because they're cutting it really close, that the majority of minority requirement will kick in, and that several of these contractual agreements might have to come to vote under that new law?
Well, we'll have to wait. The devil is in the detail. They could say that, look, the board has approved it, maybe everything's ready, but look, by all means, let it come to shareholders to vote. Let the minority investors say they like it.
So my question to you, Mr. Oswal, is this. Based on what Amit has told us, the royalty payment that Maruti is making to Suzuki is already considerably high. Once the New Companies Act comes into effect, any increases in royalty payment will require the majority of minority approval.
That's right.
Let's for a moment hypothetically assume that Suzuki says that's a tough hurdle to pass. Could they be using this structure then to find another route to extract value or profits from the India business and thereby not have to increase royalty and run into the issue of majority of minority vote?
Look at this, the press release which says that we will recover cost of production plus some incremental cost which is required for incremental cost of investment into the expansion of the
incremental capital expenditure requirements.
Cost of capital or capital expansion required. What is that incremental expansion? Today you are setting up a plant of 2.5 lakhs. So
250,000 units.
250,000 units.
Going all the way up to 1.5
million. So incremental manufacturing facility will be huge.
I'm also not sure what incremental means. The Maruti management is that different.
We are all debating based on the press release. So therefore that incremental cost will be recovered. And
from
Maruti, and therefore it is an extraction from Maruti.
So you're saying Maruti, if I've understood this correctly, Maruti will fund the expansion of capacity at the Suzuki Gujarat plant, but Maruti will not own the asset in any fashion.
Certainly it will not own the asset.
That's what you're saying. This is what that implies. The press release implies that situation.
And Suzuki will not pay tax on it, because these monies which they will receive, there will be huge depreciation sitting in their books. This will be a cash profit. The depreciation allowance will not make it subject to tax, and therefore that they will be able to extract.
Okay, but can I put another argument to you, and you tell me if this makes any sense, because you look at these complex structures every day. Today whatever royalty Suzuki charges Maruti is based on models that Maruti already manufactures. A whole bunch of new models will come to the market in the course of the next few years. Can it be that those models would get manufactured in the Suzuki Gujarat plant? Therefore, Suzuki Gujarat will pay a royalty to Suzuki Japan. That royalty will become a factor of the cost of production. That cost of production will get passed on to Maruti, and thereby this creates one other route for Suzuki Japan to charge a higher royalty on the products being manufactured and sold in India, but not through Maruti, through a private listed company.
Look at this concept which they have brought in. We will recover cost. What is the definition of cost? The issue is when you do not have the definition of cost, it is your ballpark figure, whichever figure you want to give it, and who will be auditing.
Especially if it's a new model and there's no comparable cost in the current manufacturing situation at Maruti.
That's correct. So, and therefore, if that whole of the cost, including the cost of royalty, including the cost of expansion of the capex expenditure, everything will be recovered. It will be at the cost of Maruti. The benefit goes to the Suzuki. Suzuki, in turn, will have what will happen over a period of time. They have said this agreement will be valid for 15 years. They will expand the asset base in this country, sizable asset base as compared to the historical cost of asset base of Maruti, which is an old asset value, and this will be new asset value. And then thereafter they will say, okay, let us go for merger of two entities.
Well, they've said that the Suzuki subsidiary will always remain 100% Suzuki subsidiary.
Correct, it will remain until it is merged with the other entity. It always remains. Who says it will not?
So what's the harm in a merger? They've done that similar stuff before. They've done it at reasonable valuations.
That will reduce minority shareholding from 44% to maybe 25%.
It's an unequal relationship when you are just looking at it at that stage, and that's what we are saying. A couple of things are happening here. One is the fact that, look, remember at this moment Maruti its return on capital employed is higher than what it's earning on its investments with the bank. So therefore, to say that, look, we are going to earn here and Suzuki is going to be funding it, really doesn't cut much ice. At every stage they've said, look, it's win-win, there's cash lying on the Suzuki balance sheet, they will invest
Why
it here.
don't we
We've got
believe
cash.
them? My question is
It
this.
is too good to believe.
Suzuki is sitting on cheap yen funds. It wants to put them to work. It will get a higher rate of return if deployed in this kind of investment activity. Maruti can then use its money to invest elsewhere. Why is it that we can't believe this?
Let me give another angle. It is too good to believe this, because look at the aggression with which Revenue Department in India is treating the foreign investment coming in and the valuation issues. Shell, Vodafone, Crane.
That's the issue of shares.
No, correct.
This is not even, this is a 100% subsidiary.
My dear, 1 minute. If the Suzuki contributes to the capital of Maruti today, this will be subject to challenge, because it is on a private placement. If they do it to increase their stake.
But this is a listed company. There is no question about valuation.
I disagree with you.
The market price, they will have to do SEBI guidelines.
No, if they use the SEBI guidelines, that is for the purpose of issuance of shares. Income Tax Department is free to value it on a DCA basis, because despite the fact it is a listed company, because it is only a private placement to the
This is now Shell to the power of 500, sir.
No,
but, okay,
why Shell to the power?
We come back to it. We are not doing it because we don't like their behavior in the past as far as minority investors are concerned. Again, if you look
mostly
at it,
predicated on royalty payments that you don't like.
Absolutely predicated on royalty payment. But again, if you look at it this way, you look at the board composition today, it's kind of 5 people from Suzuki, another 5 employees who will.
They have as many independent directors required as per law.
No, it's as per their definition of independence. We don't consider Mr. Bhargav as being independent, giving his extended tenure. We don't consider Mr. Ganguly, who was the auditor of, senior partner of Pricewaterhouse, who moved straight from his office in PwC to the Maruti board, as being independent.
Okay.
So if you just look at
you
the
have
composition,
several concerns that make you look at this with suspicion, as opposed to yes, win-win.
Yeah, and as we say, it's kind of weakening the relationship. As it is an unequal relationship, is getting weakened further. Maruti will have less of a say. Suzuki will say, look, these are our terms, you want it, take it, otherwise we're walking out of the door. That's it. And therefore the minority investors will also have to sing Suzuki's tune 3 or 4 years from now.
The explanation and the press release only speaks of few things, not the everything. What is the intent behind undertaking this? And I can tell you, I can guarantee you, it is going to lead to reverse merger or merger of these two companies.
15 years from now.
Within 5 years, next 5 years, or within 7-8 years, because a sizable asset base will get created by that time.
All right. I think it will be interesting to see when Maruti moves all of this, and whether they give their minority shareholders a chance to vote on each one of the aspects of this deal, whether it's the lease of the land that they've bought in Gujarat, whether it's the contractual agreements of supply with the Suzuki Gujarat subsidiary, and any other such commercial relationships between Maruti and Suzuki Gujarat. Because if they allow for that to happen and say we subject ourselves to the majority of minority rule, then I think a lot of the suspicions will disappear.
Absolutely.
If they don't allow for that to happen, or if by some quirk of timing they're able to move all of this through before the Companies Act becomes effective, then I think the suspicion will only double, and maybe we'll test Mr. Oswal's merger theory.
The timing issue is therefore very important.
All right, gentlemen, thank you so much for raising questions that we hope Maruti will answer. Before I say goodbye, a quick reminder to visit our website. KPMG's Jameel Khatri is writing an ongoing column on the Companies Act, and the latest edition is on higher auditor accountability. Make sure you keep up with Jameel. We'll see you next week.